Okay, so welcome everybody to our very first conversation around personal finance. The goal of these sessions is to really help our community shift how we think and talk about money, right? And our relationship to money. I think everybody's sort of in this place of wanting more financial independence, more confidence. And so this is the first of several conversations we hope to have around this topic. So thank you for joining. Um, just a disclaimer. So obviously we have some experts in the room, and actually we have a lot of experts as participants as well. And you may have your own sort of take on things, which is great. But this is not a substitution for actual financial advice. Some people on this call are financial planners, but again, don't take that for, oh my gosh, I need to sell everything and buy this specific stock or something, right? Like just, be very mindful about how you do that and consult your accountant and whoever else you work with to manage your money. Okay, cool. Disclaimer. So then the next thing I want to do is we have, oh my gosh, almost 40 people on the call, which is super exciting. And I'd love for everybody to just take a quick minute and introduce yourself over chat. Would love to know, what brought you here today and what years you were at Google, assuming that you're a Xoogler. So go ahead and take a minute and just like type your, again, what years you were at Google or are at Google and what brought you here today, just so we can get a sense of what people want from this conversation. People just really looking to grow their pie. That's what I'm seeing a lot of in the comments. Yeah, organizing your finances, growing them. Esther, very sweet. Great. Yeah, no, I think that this is really the story, right? Is a lot of us have some money because we were fortunate enough to work at Google. And, some of us know exactly what to do with it. And some of us really are searching and trying to figure that out, right? We also maybe have different relationships with money. And so we can absolutely talk about some of the emotional aspects of it as well. But to help guide our conversation, some quick intros of our panelists. So we have Sarah Payne here. Sarah, why don't you wave? Sarah is Ex-SoFi, which is the financial services and lending company. It's a bank, actually, right, Sarah?
Yeah, they actually are these days.
They are all of those things. She's a Xoogler and a certified financial planner. And she actually, while she was at SoFi, developed a financial wellness course to help spread knowledge around personal finance. We also have Jerene Yang. Jerene is currently a senior engineering manager by day, but a stock market investor by night with multiple successes. And she's actually still at Google. So if the conference room looks familiar, she's in the Sunnyvale office right now. So thanks for coming early and joining us. And she currently leads monthly conversations at Google around just the stock market. And she also on the side owns a financial advising company. So we're super excited to have both Sarah and Jerene. And Terry is actually the co-planner of these events alongside me, but she's also the founder of The Brass. She's a Xoogler and former Wall Street investment advisor. And she commonly leads women in money conversations and salary negotiation clinics on Maven. And she cares just deeply about sharing her financial knowledge and how your decisions can impact your finances. So, or your career decisions can impact your finances. And then, of course, I'm Stephanie Lau, your moderator. I'm a longtime Xoogler community organizer, leading New York right now and lots of different women's events virtually. So it's really nice to meet everyone. Okay, so this is for you, right? I've said this already. You put in what your intentions were in the chat. And I want to make sure that we spend the bulk of the time answering questions that you have around money, right? So do not be shy. If you have things that you're looking to get out of a conversation like this, please ask. We have a couple topics that we prepared in advance because we saw the incoming requests, and they were around overcoming your financial fears and sort of having a better mindset with money. They were also around practical steps to growing your finances, and then also around, how you can make better career decisions for yourself to help grow your finances. So I want this to feel interactive. If at any point, even while I'm talking or one of the panelists are talking, you have a question, please use the raise hand feature to ask the question. We'll stop and we will, go to you and let you ask. Please also use emojis. So I know that there are some reactions in the toolbar for Zoom. We love the reactions. Let us know if this is, useful for you. I see. Yes, exactly this. Love the hearts. And again, if you are shy and you prefer not to be recorded, please use the chat box to ask your questions. Let's go ahead and start with our first question. This is just a warm up for our panelists. You guys have so much experience with money. I'm curious, what is the most significant learning you have about managing finances and gaining more agency over that? And so let's go ahead and start with Jerene.
Sure. Thanks so much for having me, Stephanie. So to me, right, I think the lesson that I learned the most is start early, right? I think a lot of folks fresh out of college, like they don't know what stock market is, what investing really means, what 401k means. So being able to educate yourself early and investing early, I think is a very important thing. And second thing is don't keep too much money in the bank, like in the savings accounts, in the checking account. I made that mistake a lot in my early years as well. When I took that money out and put it into the market and have it work for me, that's when my finances really started to grow.
Amazing. That one feels like a fear question, and so we're going to definitely come back to you on that, Jerene. Sarah, why don't you go next?
Yeah, I think growing up, money was not something that was talked about. It either was there or it wasn't there, and it always felt a little bit scary. And so I think for me, something that felt really empowering was even just taking steps to acknowledge that I didn't know as much as I wanted to, and like that I could learn more and sort of believe that this wasn't an insurmountable topic. And so I just want to acknowledge and honor, everybody who is on this call, whether as a panelist or a participant, that like this can be a really big deal for some folks.
Thanks for that, Sarah. Terry, go ahead.
Yeah, thanks, Sarah and Jerene. I love what you said about learning early and then also just learning in general. And I think that's what I've learned. I've learned that through women in my family who were suddenly left having to make financial decisions. My grandma, when my grandpa died, and then my mom, who was divorced in her mid 40s, who's now 80. But thanks to like gaining knowledge and identifying, where they were and where they wanted to go, and then understanding how to navigate market uncertainty and assessing risk, they both were able to come out of, really a very stressful time. And I see that with, when I was running investment seminars at Merrill Lynch, and then today with salary negotiation. So it's, the knowledge piece is really important. That's why we're all here, and it's awesome to see everybody. But I like to talk about this assessing risk piece too. That's one of my favorite topics, and how to kind of manage the uncertainty of the market.
Yeah, let's actually get into that, because I think that is a big barrier for folks when it comes to handling their money. And I know Sarah and Terry, you have pretty strong opinions about this, right? Let's talk about some of those common fears and, what you hear from clients and people that you've worked with, including yourselves, and how you advise or have helped people overcome some of those fears. Either one of you can start. Yeah, go ahead.
Go ahead.
I would say two things come to mind around common fears. Fear number one is I'm not doing it right. Like there is one right way to do it and you are not doing it correctly. And I think what I found is there are a spectrum of ways to do it correctly. And it's really about understanding what it is that you want to do and like how you want to interact with your money, and then figuring out what works from there. And the second fear, I think the second fear is that it has to be complicated. It involves numbers, and it involves, rules, and it involves, in some cases, sort of government or tax structures or those kinds of things. And it can get very intricate and complicated, but it can also be fairly simple. Again, just to like, what is it that you want to do and what do you have the appetite for? Those are sort of the two things that I tend to chat with folks about. What about you, Terry?
Yeah, thanks, Sarah. I think, those are super important points, and there are different paths to managing your portfolio. And I think a lot of us talk about, and I think, Sarah, you had mentioned this when we were talking about this topic of, even in investing in index funds or investing in something that you can, really kind of invest in where you're reducing your risk. Yeah, the market fluctuations are going to be there, but you stay in the market. I'm talking specifically about stocks, by the way. There's all these other investments, but if you stay in the market, it historically has shown in these major downtrends that we had over the last 10 years that your portfolio will go up. And I think it's really understanding that, and the fear piece and the lack of doing it right, this helps kind of overcome that. And I was going to pop a couple charts in the chat here because I found this.
Yeah.
I found this illustration is really great to explain what my point. But this is by investment advisors, right? And I didn't know they had this chart until recently that shows the last 10 years. Usually you see like since 1989 when the market first crashed. I was in investment advising people at that point. But this is such a great example because I think we all can relate, if not the last 10 years, at least to the last 5 and some of the market downtrends. And if you stayed in and actually added during those times, you would be further ahead. So this is a great chart. And I can also pop the article in there too, if anybody wants to read it, but I'll do that later. But anyway, that's what I would say. Stay in the market in the downtrends.
I love that. I have heard, yeah, if you hold for long term, it will grow. Jerene, anything to add or?
Yeah, so I think getting into the market is tough. There is never the right time. How do you know, especially in a downtrend, how do you know that this is the bottom? So the only way to do this in a very regimental fashion is to what we call DCA, dollar cost average. So whatever you want to invest, break it into say chunks, like 10 chunks, and just every month just put it regardless of the price of whatever the stock you're trying to buy, right? And when you're first getting in, broad-based is way better than single stocks. So broad-based are like SPY, VOO, things that have a lot of companies and they are weighed based on how really they represent the entire market. So these are really good places to start and just keep at it.
Yeah. With those acronyms that you dropped, Jerene, just for the layperson, those are mutual funds, they're ETFs, electronically traded funds, and they're portfolios of stocks, right? Is that kind of an accurate summary? Okay.
Right, they're all ETFs, broad-based
Okay.
ETFs. Broad-based means they have a lot of companies and represent many sectors in the market.
Amazing. Great. Any questions on this topic of overcoming fears? Jen has a question. I can ask it on your behalf, Jen, or if you want to. Oh, no, it's not a question. I'm just kind of catching up on the chat. Yeah.
Yeah, I can go ahead.
Yeah.
Hey everyone, my name is Thebes. I'm a current Googler. I was just wondering, like, what do you guys use to do your, monthly investments? Do you just, make sure half of your paycheck or a certain percentage goes into your brokerage fund? And then how do you auto invest in ETFs? Do you use any sort of tool, or how does that look like?
Right, I can take that if folks are okay. Okay, so I've tried every single brokerage out there because I day trade, so I have to figure out which one gives me the best fill, which one gives me the lowest cost. But I think every single tool, every single company you hear out there can do this, right? So it's really what you already use. A lot of us use Vanguard because that was where our 401k went. Vanguard's a great broker to use this, right? So what you can do is every month, right, as part of your paycheck, put that into Vanguard. And Vanguard, when you buy a certain stock, you can have this thing called auto invest. So you can just say every month, $5,000 will hit here, or 500 or 50. It doesn't really matter what the amount is. It's more of like getting in the practice, getting in the groove of regularly putting money into a brokerage account and then always buying a certain thing. And I recommend it to be SPY at the start, which is just a broad-based index fund measuring the entire market. Once you get confident there, that's when you can now start venturing into individual companies with low betas. Beta is a Greek which measures the volatility of a stock with regards to SPY. The higher the volatility, of course, the higher the chances you will make a lot of money if you're successful, but those are very risky. So recommend just starting off with a broad-based index fund and just doing this via Vanguard, which we all have because we all have 401k accounts with Google ones. If not, Charles Schwab, Morgan Stanley, whatever your equity went into, those brokerages are good. And all three brokerages offer free single stock purchase. So if you're not doing options or futures, just the regular stocks, they're free. So all three are really good. If you want to use something on the phone, the best, I think, experience is Robinhood. But that one, like setting up recurring monthly stuff is a little bit more tricky. But yeah, that works too for regular stocks.
Yeah, Jerene, I love what you're saying about the dollar cost averaging and getting systematic about your investing and not being afraid to do that. The other thing I would add, we all probably know this, so I might be saying something but it also applies to your 401k plan. I think that we don't realize sometimes you want to max out your 401k plan. You want to get that match if you can. And that also helps with dollar cost averaging. And I think there's a question on, how often do you monitor your investments? I think that depends on how active you are in the market. Like, Jerene, myself, I'll speak for myself. I look at the market on a daily basis, but I'm not saying that's a recommendation. It's just a hobby and a passion for me. But as far as managing your portfolio and rebalancing it and asset allocating, you could do it monthly or quarterly, right? And you don't necessarily have to make a change. So it's good to let the market, kind of do its work for you. And then I think someone had a question about like keeping cash. You always want to have some cash on hand to take advantage of a downtrend, or just to have that if you're really nervous when the market goes down. But, I agree with Jerene, and all those specific providers have so many options and ways to evaluate stocks and other investments.
Awesome.
If I can just chime in, like, my anxiety goes up to like an 11 when I hear about the idea of monitoring the market daily, which isn't like, that doesn't mean that it's wrong. It just means like, I prefer to put money in a space and like know that it's set, look at it at regular intervals, which, for me is generally like maybe once or twice a year. Like, that's just my personal approach. And like, that helps me out like quite a bit. So I just also wanted to call out that like there's kind of a spectrum, which again, it doesn't mean that it is like right or wrong. It's just, like the thing that will ratchet up my anxiety is like looking at those fluctuations as opposed to like staying the course, in my case. And so I've just learned to kind of like manage myself to be able to manage my money.
Yeah, and that gets to Mindy's comment in the chat, like that helps answer, I think. But just how frequently should you be looking? Okay, let's go ahead and pick out some of these questions in the chat because we have a lot, so it's great. So on diversification, right? So Yi has a question. She has, advisors asking her to diversify her portfolio, but obviously, like many of us, a lot of her stocks are concentrated in tech, which is obviously on the rise. What do you think? Opinions welcome.
I can start again. So tech actually makes up a very big sector, very big portion of overall global liquidity and finance, right? So it is okay for you to be concentrated in tech. In fact, I would say that anyone who is invested in the market as a whole, it's kind of concentrated there, like 30 to 40%. If you are on QQQ, which is the NASDAQ one, that one is like almost 60% tech. So tech makes up a lot of the products that we're using in the world today, right? So, and that's really what stock is measuring. The price of the stock should previously be correlated, not hypothesize, but be correlated with how much you are producing as a company, right? If you're producing more for the world and the world is using your products, your market share will increase, your stock price will go up, assuming you have the same number of stocks. So yeah, so most, I would say, a typical percentage of your portfolio should be around 40% to 60% of your total portfolio, not your net worth, being in tech. So if you're like at 100%, sure, diversification might be good for you, right? But if you're in the company and you're extremely bullish about company and you're seeing things that other people are not seeing, there's no harm in putting 100% of your portfolio in a very large tech company. So like Google, Amazon, Meta, these are considered large tech companies. But if you're like in a just IPO small startup, say Snowflake, that might not be a good call. So it is okay to have 60-40% of your portfolio in tech, and that's okay.
I like that hot take. Any differing takes?
I like that take too. I also I'm kind of in the middle between Jerene and Sarah as far as, well, to be 100% in tech or 60%, I go back to the risk. You have to think about, can you take the market downtrends? Because when the market goes down, there's a huge tech sell-off. And I think that's just really important to kind of get in tune with yourself and sort of your mindset. I have to say, I had, what's the word I should use? Like an experience that I never want to have again. This is when I was managing money back in the 90s when we had the dot-com bubble, and I learned from that. I learned more when I lost money than when I made money. There were stocks, people had 100% of their investments, and they worked at these companies, 100% of their net worth in stocks like Inktomi as an example. And that stock, exceeded 200 when it went public. I think it was in 2020, and then 2022 it started trading at $1.52. So I actually saw people lose massive amounts of their net worth, which they're never going to get back. Now, I don't want to scare people, but I think I'm just really cautious about taking that risk. And I know, Jerene, you're not saying, hey, do something like that, but I just have that experience in the back of my mind, and it was so stressful seeing people's portfolio go down that much, that I'd rather have a lesser rate of return and maintain, a nice, consistent growth in the market than betting on, one position, even if it's a really good stock. So that's my experience.
Because those tech stocks are probably considered high risk in some cases, right? Not every case. It's mixed. Okay, yeah. So mixed risk depending on what you're investing in. Okay. Well, let's go to another question from the chat, which is just on the topic of 401ks and retirement now. And so curious sort of how people are handling, their 401ks now that they've left Google, and if you have advice for what actions we should be taking, if any, when we leave Google.
I'll kind of just kick it off.
Mm-hmm.
My Google 401k is still actually in Vanguard in that account, like partly because I just didn't feel like dealing with the admin and paperwork, like at the time when I transitioned out, and also because, Vanguard offers a lot of really great, sort of low expense ratio, low cost funds. And one of the things that I know of myself is, if I'm not really sure or I'm a little bit scared, I should just sort of wait, because when I've taken action in those emotional spaces, it usually ends poorly. And so in my particular case, like to start, I was just unsure of where it should go. So maintaining my 401k there made sense. And then, as that kind of dissipated, I made the conscious decision to maintain it there because, when I actually took the time to review it, it felt like the right place for it to be. For other jobs that I've had, ultimately I end up consolidating those into either a rollover or the same, 401k space, just so that I have a cumulative amount, and that isn't necessarily a recommended approach, but that's something, that I've done. What about you, Jerene or Terry?
Yeah, for me, I've always rolled over my 401k into my own personal account, like my Schwab account. And I tend to balance the investments. I have, I'll have a set of mutual funds and then some individual stocks and then some cash. But, I'm really a big advocate of, if you can, even maintain those stocks or the mutual funds in the 401k plan if they're really doing well. Sometimes you can make that transfer. But I've always took ownership of those funds because I like to have agency and decide to sell if I want to or add to those in different ways. But yeah.
Yeah, to me, it doesn't really matter. I think it's whatever is most convenient, right? So every single company out there that offers 401k give you similar funds. So, but I like the Vanguard ones. I think Vanguard gives the best, like in terms of range and variety and low management fees, like for each of the like, mutual funds that you would buy. So I think leaving it in Vanguard is good. Taking it out to be managed by somebody else, like another company, and having the equivalent swaps is also good.
Yeah, I would add to that too. As far as if you move it from like a Vanguard, there are ways, and you all may know this, where you can evaluate mutual funds if you want to have something similar. Like I saw some really great T. Rowe Price funds that had 5-star ratings and had really great rate of return. So there's ways to sort of maintain more or less the integrity of your 401k by investing in similar mutual funds. But I think these that we're mentioning, Vanguard is really great. You have to remember, like, these companies have billions of dollars under management, and they really do know what they're doing, and the fees are much lower if you pick some of these types of funds.
And just to make sure, I understand, and also for others who may be newer to managing and playing with their 401k, some of the options after you leave a company would be: 1, leave it where it is; 2, roll it over into your future company's 401k plan, right? So to Lee's point, basically consolidating your 401ks into like a one account. And then the third would be to roll it over, but to put it into sort of an IRA equivalent of some sort, so a different type of retirement account. Does that sound about right? Okay, great. So just to Jerene's point, it's really what's convenient for you in terms of like how you decide to do that. And so for people who change jobs frequently, obviously it might actually make sense to put it all together, right, in the same place. Okay, and we have a hand up. So Claire, why don't you go ahead and ask your question?
Yeah, this is kind of has been answered in the chat, but curious on, since we're on the topic of 401ks, on the target date funds, and if there's downsides of simply just sticking with that.
So yeah, I can take that. So 401k funds, especially with target date funds, they are meant to be rebalanced essentially every year or twice a year. But essentially, there's someone who's looking at it and adjusting it based on how many years you have left to retirement. And they're de-risking the portfolio every year as you near retirement. The problem with that is it does limit your upside as well, right? With risk, there is reward. Without risk, there's really no reward, even in this market. So as they limit, so they're going to go bond heavy, stock light towards your retirement, it does limit your rate of returns. However, it is good for most folks. It is a retirement fund. It means that when you retire, you will need access to this cash. You don't want it to just grow for who, right? So it makes sense for most folks, but if you just want this to grow as fast as possible, you may not want to use a target date fund, or you may want to keep changing the target date for your target date fund. So say, I'm 30, I'm in my early 30s, right? I will retire, say, in 2060. But maybe I want to be a bit more aggressive. I'll pick the 2070 target date fund. Then next year, I'll pick the 2080. Whenever the newest one gets available, I will keep moving. So you can do that too. You don't have to stick to your actual retirement target date fund. But in general, that's just what works for most people, because you do want lower risk as you get nearer to retirement.
Yeah. And actually, Thebes has a similar question, which maybe is also answered here, which is, just what should we be expecting in terms of average returns in a 401k?
So yeah, go ahead. So yeah, it starts at around 10% when you're, so it depends, right? Because it depends on how the market is doing. But the risk for the 401k when you're in your early 20s to like late 20s is meant to be around, to give you returns of around 10%. Of course, that also means that you can have like a negative 10% return, but that's okay because you have so many years till when you retire. But as you get closer to retirement age, late 50s, early 60s, and if you're still using your target date, like a target date fund based on your actual retirement, then that will become very, very low risk. Typically, the returns are 1 to 2% because it's just bond. So it's just interest money that you're making at that point. But yeah, so it will taper down as you get closer to your retirement age.
I think the question, thanks for answering that, but I was wondering, like, if you are 30 and you've invested in your 401k for 8 years, what are the typical returns on your entire portfolio that people are looking at? Is it typically in the 10 to 20%?
No.
Is it 50%?
So the past 10 years have been very atypical in the stock market compared to the prior 10 years and 10 years and 10 years, right? I think the past 10 years, depending on where you were during the COVID crash and the COVID spike and where you are right now, has been higher than prior, like 10 years. So I would say for the past 10 years, it's about 10%. But for prior to that, like if your 10 years ends in 2012, your returns is more like 6 to 7%.
Anything to add, Sarah and Terry?
Yeah, I guess maybe implicit in your question is like there's probably a return that you're seeing on your 401k and you're wondering how that stacks up against maybe an average or an expected element. Maybe that isn't correct, and please correct me. But
that's correct.
Yeah, I think Jerene, what you were speaking to is like, depending on which 10 years and which investment, kind of the bar, the line might be more or less. And, I think kind of the general rule of thumb, that I've heard, especially if you're, considering kind of like a medium risk investment, is usually kind of that 7% per year. Again, like super duper on average. Going back though, to some of those elements of target date funds and, kind of evaluating investments. One of the things about target date funds is there's an assumption that when you're young, you have greater risk tolerance, right? Which means like you've got 50 years until you need that money. So if there's a big spike or a big downturn, you can kind of, weather it. Risk tolerance and risk capacity are highly personal though. Risk tolerance is like, do you personally, like, can you handle seeing a number go up and a number go down? Risk capacity is like your actual financial ability to weather those ups and downs based on your financial goals and your financial needs. And so I recognize that this can kind of get into that complicated element, but a big part of it, and Terry, I think that you've noted that you are really passionate about talking about risk, is just having like a really good understanding of, how much risk capacity and tolerance do you feel like you have? And based on when you think you're going to need that money, if it's tomorrow or 50 years from now, kind of finding an appropriate investment that really, kind of speaks to getting you where you want to go, given that time horizon. And some of that is, maybe working either with a financial planner or a coach or an investment advisor for a short period of time to talk through that. And sometimes that is, going extra deep on Reddit and, and the internet and whatever else to just sort of educate yourself on, what do folks who have, a similar risk tolerance and capacity, kind of what are they saying about some of those investments for, retirement? Yeah.
Yeah, Sarah, you hit on something that I wanted to jump to, but Terry, before I go there, do you have anything to add?
Well, I was just going to add a quick thing, Sarah, about what you said. And I think it's really good to remember having a plan is really important, because that's where you actually can sit down with yourself, your family, and decide what can you tolerate as far as And I love that, your risk capacity and your risk tolerance, because that's going to actually drive the investment decisions that you're going to make. And then you're also going to have historical data that maps up with those decisions to say, okay, if I have this risk, tolerance, here's my pie, here's where I'm going to put things. I can and you're setting expectations by having a plan. I can expect 7% or 10% in the market or whatever it is. And then if you exceed those expectations, great. But I think you have to set your expectations by having a plan. Like I think it's, and I think today, a lot of people, including myself, you see all these, investments happening. You see GameStop, you read Reddit, you see people who are putting hundreds of thousands of dollars into one position and winning. These are these edge cases. I can't emphasize more to, if you want to do that, fine. Like I'm not saying don't do it, but just know a plan is so important, especially when you're making decisions, not only for yourself, but for your family.
Yeah.
I don't mean to sound like everybody doesn't know, by the way, like I know we're all very smart people, so I don't mean to sound like I'm,
No.
preaching or something or talking to us like we're kids, but I always have to remind myself, what's the plan? What was the plan?
That's a huge one. So many people on this call have families, right? And are thinking about their families as they're making these investment decisions. And I'm sure that's where some of the fear comes from as well, right? So when you're not just investing for yourself, but you're investing for others as well and their futures. On the topic of having a plan, selecting an advisor, right? There are a couple questions in the chat around what the right, like one, whether you should just do it yourself. Two, right? Obviously hire someone, and what is a good way to select the right financial advisor for you. There are some obviously payment structures for these advisors, and so people have some questions around that. Maybe Sarah, let's start with you since you are one. What do you think?
Sure. I would clarify. So a certified financial planner, we are fee-based, which basically means you pay a flat fee for, I personally don't like the term advice. My approach typically is more education. It's kind of like, you can do this or that. Like, what have we said the goals are? And given these two options, which one, seems appropriate given your risk tolerance, how fast you're hoping to achieve this goal, what are other, just sort of life considerations, those kinds of things. That's kind of my personal approach. And one of the reasons why I sought out the CFP certification is because it requires fiduciary standard, which basically means I'm required to act in your best interest, not the best interest of a company that I work for, or sort of like shilling a particular investment, because I am, highly compensated for that investment. In theory, I could do that. I have not, and I don't, but I would just need to disclose to you that, I get a commission if you decide to invest in a particular fund. That is not the same standard that all investment advisors are held to. And technically, investment advisor is a generic term that your brother's cousin's, like sister who read a thing, or went to, like I'm a badass, at money seminar and wants to recommend, like technically anybody can call themselves an investment advisor. Nothing wrong with that, but there's just a point of awareness of that term doesn't necessarily mean something in particular. It's sort of a generic term that you would hear. And so really looking for, certifications, getting curious about that fee structure and those hypotheticals, kind of asking about either any conflicts of interest or any other compensation structures that arise from recommendations that are made are really useful. And then I would just share, like, my barometer for myself, especially when I was exploring, working with a financial advisor to start, was, did I feel like they respected me? Because to be really frank, like, I chatted with a couple of folks who were like, pat on the head, I'll take care of it for you, don't worry about it. And I was like, no, no, thank you. Like that doesn't work for me. And I didn't like that feeling, and I didn't work with those folks, you know. So yeah. Terry, I know that you have worked formally in investment advisement. So, you know, I'm sure that you have a perspective as well.
Well, yeah, Sarah, I'm really, I mean, I love everything you said, because I totally agree. And it is to be careful, like you want to talk about, hey, what to be careful about. You know, if you have an investment advisor, I mean, you have to be licensed, but also know you don't want that person, like Sarah says, that pats you on the head and says, hey, I'm going to manage this for you and you'll get your statements. I really care so much about, we as women especially learn about investing. And if you can do even part of it on your own, I mean, you really feel good about your finances, right? You feel good about learning and don't feel like, hey, I don't know what's going on. The one thing I wanted to say that really piggybacks on what Sarah's saying, it's like every profession, not all investment advisors are great. And you have to know that many of those people it's commission based. You might not see it because there's fee based accounts, but they also they're salespeople. Okay, so they get compensated also. Hey, if a mutual fund company comes in, gives a presentation to all the advisors in the office. I mean, I experienced this myself. They say, hey, what's the latest, greatest fund? And then they start, positioning that fund into people's accounts. Now, I'm not saying the funds aren't always good. Just know many times that role is more of a sales role. And back to Sarah's point, they're not thinking about you. They're thinking about, well, how much of this particular investment tranche did I sell to customers because I got paid a certain percentage to place those investments. I don't want to sound down on investment advisors. I think they're really, really amazing, but just know there's, you got to be your own advocate.
I love that. And actually, that raises another flag for me, right? Which is there are lots of blogs that I'm sure that people follow on investing, right? At any quick comments on how we should be reading those blogs, maybe with caution. I don't know if you know anything about that, but things like, promote, it seems really similar to some of these presentations and the commission-based fees that people might be getting for promoting a fund, right? So I don't know if anyone knows anything about that.
Yeah, I actually wrote my my master's thesis on the proliferation of finfluencers on TikTok and Instagram and other social media, approaches. And a couple of things. One is I love that they normalize a conversation about money. It's been a shameful topic for so many people for so long. And I think if nothing else, it is really useful, to have folks who are willing to talk about money and investments. In the research that I did, though, the most popular financial influencers on social media often have the least number of credentials or formal kind of training in finance, which isn't necessarily a bad thing, if they're really clear about it, but they might be making recommendations, Terry, to your point, where they are compensated by financial companies in order to say things. They are influencers. That is how they, they make their money. And so just being highly aware, folks are probably maybe remembering, I think Kim Kardashian was actually fined by the SEC for recommending, an investment without appropriately disclosing that she was getting compensated for that recommendation. And so it's like, I might take a makeup tip from Kim Kardashian. I don't think I'm taking investment advice from her, but there are probably, like a few 100,000 women that are like, well, Kim can do all of these things, so I should invest a little money here. And that might be fine, but if you aren't aware that the reason why she might be doing that, has to do, with the way that she's being compensated, then that can actually harm your own financial strategy. So, part of it is know who you're taking advice from. I personally think it's like, if you connect to somebody, if you feel like what they're sharing makes sense to you. If it helps you feel educated, if it helps you feel empowered, that's great. But also don't necessarily take folks at their word, like do additional research. And I think anyone who is, really good in this space is going to say that to you as well. But also, just given that we are all, very smart women, like that's just something to kind of also, kind of do that additional homework on. Guess it's not blogs, but it's 2024.
Oh, 100.
Like some of that is stuff.
Wow, I'm so dated. I'm like, you read a blog? Nobody does blogs anymore. You're absolutely right. But anyway, thanks for the tip, Sarah. It makes a lot of sense. Okay, I want to switch gears a little bit away from simply investing because we've talked a lot about that. I do think it's going to be a huge part of your portfolio. But, Laura asks a great question, which is, some of us are in sort of a sandwich stage of our lives, where, we're taking care of aging parents and ourselves and, kids if we have them. Just what do you think is the right mix of investments? And let's talk about more than simply stocks and mutual funds and those things, right? Like there is obviously real estate and other things that you could be doing to kind of grow your entire pie in terms of wealth. What are some of the things that you guys think around the best mix of those types of things?
So I can start, right? So the way that I recommend most folks think about, just planning out what percentage goes where. First is you should have 6 months of your monthly expenses. And if you don't know what your monthly expenses is, that's a really good, excuse to write. Just take a look at what you're spending, all of your credit cards, and then all those annual fees that you have to pay for your annual credit card fees, your, end of year present giving, right? Because you give lots of presents and people love you, or like, your travels, add all those up, divide by 12 to get the monthly, and then add to what you pay on a typical month, like, your daycare, commute, gas, all that. So then you have a sense of what you spend every month. Do that very diligently for 2 or 3 months to see if there's any, up and downs, and then take that amount, figure out what 6 months looks like for you, that you should have in cash, that's in your savings account or your checking account. Another 6 months for folks who are a bit more like, I want to make sure I have enough money. If I get laid off, my spouse gets laid off, we'll be fine. Another 6 months I recommend in T-bills, because right now interest rates are a little bit higher. So T-bills give you a typical 5% return of your investment. And if you're in a very high state tax area, that's state tax free. Whereas, all these like high yield savings account, you have to pay state taxes on that as well. So that's a 10% for most of them.
Sorry to interrupt. What is a T-bill?
T-bill is a treasury bill. So this is like you lend the government money, right? So they can default, but typically when they default, they will still return you. And the US government does not default, but like say it did, you will still get your like base back. You might not get the interest on it.
So a T-bill, would that be the same as a bond?
No, it's different.
Oh, okay. See, look at these learning things.
You can get T-bills through Charles Schwab, but I recommend you get it through Treasury Direct, which is a really bad UI, but that is what the government uses. But that gives you actually one of the highest interest rates. So 6 months there, recurring every 6 months, and that gives you a pretty nice chunk, like 5%. Then after that, that's where you want to put in. So now you have 12 months of expenses covered. Then after that is what you want to start investing, right? So whatever is that left there, 80% I recommend in a very stable form of investment. This means broad-based ETFs. This means like some mutual funds that Vanguard offers with very low risk, or this can be real estate, but real estate in a not a hypey place. Like like for example, Bay Area real estate hardly ever crashes, so that's okay. But if you're gonna buy a real estate in an area that you think is opportunistic, that will be a bit higher risk. That will go to your last 20% of whatever you have left. And if you do day trading, if you do lots of like buy sell futures options, that's where the 20% is. That's the area where you can have very high risk but also very high reward. So that's how I recommend folks usually think about their entire net worth.
Anyone want to add anything to that, Sarah?
Yeah, I'm like a little bit in this space right now, which is but Jerene, I think you're right. Like Bay Area real estate doesn't crash, but there are definitely fender benders. The I have an aging parent, that is a constant consideration for sort of today's expenses, but also tomorrow expenses. And so one of the considerations, when I work with, my own financial planner, because I like to have a separate perspective, is, kind of like what is that future state? Like how would we pay for additional care? There's, sort of my today, considerations on, like, we're trying to do a renovation in our current house, and that comes with a lot of zeros, but also, the tech industry is going through a bunch of layoffs. So how risky, do I find it to potentially pull that money out of investment in order to pay for this renovation? It's like, is that something that I can handle? And then there's also sort of the future state of, like, what are those expenses in potentially paying for college? Or frankly, I would be really happy with a kid who is a plumber, because those folks make a lot of money based on my experience. I kind of don't care about that. But, there are a lot of tax efficient ways to plan well into the future, that if you're aware of them can really support that. And so I'll come back to, I think, Stephanie, you were so kind at the very beginning of this of kind of identifying folks as experts. And I do not tend to call myself an expert, because I feel like every day there is something new that I learned that I didn't know before. And I'm kind of like, crud, like I should have known that, and I didn't. And so I do like to still work with someone, even as as I am a point of knowledge for others. I still like to work with somebody separate from me on very particular needs. And so if there is a particular goal or a point of awareness around a family change that I know is coming up, I will usually engage and just say, hey, here's what's coming up. Here's the current plan. What are tweaks to the plan or things that I should be aware of? And that maybe it's just recertifying what I was already planning to do, but I find that to be, pretty useful. Yeah. And I'll just share, my only real estate investment is my current home. That's because I don't like property maintenance for my own space. So I personally don't want to own a whole bunch of other properties, but there are some folks who do, and I know people who do that and they love it, and it's great. It just isn't, for me personally. So I realized that was a bit of a run on, but
no, that's fine. I know we are actually at time. So, I mean, this was eye-opening. I know for me personally, I know that I'm going to rewatch this video and start looking some things up. But I see several topics that we didn't even get to hit on. So one being, for example, the worksheet that we sent out, people kind of wanted to talk about it a little bit. Let's set up a second session like this on just kind of understanding your full net worth, right? And your monthly expenses, which is something that Jerene touched on quickly. And then Janelle had a question around career management, and we didn't even get to that, right? I know, Terry, you love that topic. And so let's come back to that, right? Things like negotiating and up-leveling yourself for your financial benefit, long-term financial benefit. This was so phenomenal, and just loved seeing that almost 50 people joined this call. So we're going to send out a survey after this. Please let us know what you want to hear about next, and Terry and I will get on organizing it. So huge thank you to Jerene, Sarah, Terry for your time, your advice, your expertise and thoughts on all of this stuff. And let's get it. Let's go get that money, guys.